Gold is usually like a forecaster of things. It feels it before everyone or the markets do. So I think that's what it's pointing to. And as for the gold market being still early days, that's the second leg. You had 2002 to 2011. That was the first leg, and then we had a consolidation basically since 2011 to 2024. Yeah, it's saying that we still have a long way to go compared to the other second legs, and in terms of time and price. So that's the way I see it. And with the fundamentals as they are, I think the risk is not having enough gold or silver for that matter.
Gold has always been a beacon of stability in uncertain times, offering a hedge against inflation, geopolitical turmoil, and currency fluctuations. In fact, leading investment bank Goldman Sachs has recently turned heads with its forecast for gold prices to soar to $3,000 per ounce by the end of 2025. Urging investors to go for gold, the bank's optimism is rooted in soaring central bank purchases, strong demand for gold-backed ETFs this year, and geopolitical uncertainties fueling a shift towards safe haven assets. Financial analyst Mario Innecco discusses the strong potential for further gains in time and price. Citing Incrementum AG's research, he compares the current gold bull market to past cycles, suggesting it is still in its early stages. In his analysis, Mario emphasizes the bond market's key role in setting credit prices, noting the 10-year Treasury yields rise from 3.6% to nearly 4.5% after the Fed's unexpected rate cut. Moreover, U.S. Treasury yields experience the sharpest decline since August but remain elevated due to expectations of a less dovish Federal Reserve. Rising yields typically strengthen the U.S. dollar by attracting more investment, indirectly weighing on gold prices. However, gold's downside remains limited by ongoing concerns about the Ukraine-Russia conflict, which supports its safe haven demand. While reflecting on trends, Mario argues that the traditional inverse link between Treasury yields and gold prices has weakened, driven by rising central bank gold purchases. Concurrently, he underscores Poland as the top gold buyer this year, reflecting declining global trust in the debt-based U.S. dollar. For years, the head of the National Bank of Poland has emphasized increasing gold's share in national foreign exchange reserves to 20%. After the October purchases, this indicator is nearly 18%, meaning the ambitious plan is within reach. While discussing the gold market, Mario addresses how 2020's stimulus measures fueled inflation, comparing it to recurring inflationary waves during the Great Depression. Highlighting current economic fundamentals, Mario stresses the critical need for gold and silver holdings. Now we present the clips of Mario Innecco's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I mean, market-wise, one of the things I'm really looking at right now is the bond market. And I know the bond market is a market that's not really followed too much by the general public, but I think is the most important market because it determines the price of credit or money, if you want to call it. And ever since the Fed cut rates unexpectedly, really, not that they cut, but the amount that they cut back on September 18th by 50 basis points, the 10-year yield has gone up from 3.6 to around almost 4.5 right now as we speak. And that usually doesn't happen. So it says to me that the bond market and a lot of people think the bond markets are like the smart money. They're saying that the Fed made a mistake. So I'm looking at that because if that 10-year yield continues to creep up past 4.5 towards 4.75, look out for all the other markets. Would it hurt gold? Because some people think that a higher real rate on treasuries would hurt gold. I don't think so because that relationship has kind of been broken. And with that, I'll jump to the next reason, next theme, I think, is one of the reasons why this relationship has been broken is central bank buying. Not just from Asia and emerging markets. Now we're seeing like in Eastern Europe, Poland, I think, is the biggest buyer of gold this year in the world, the Polish central bank. And I think that's going to continue because the world sees that the reserve currency that we have, which is actually historically, it's the only reserve currency that is debt-based, which means you never get paid as a country if you have U.S. treasuries and you go to the U.S. Treasury, let's say as Poland, and you ask for payment, they can't pay you. They just say, "Well, buy some more treasuries." That's how they pay you. In the when there's a proper monetary system, you go to the Treasury and you get payment in gold. So I think the world sees that. We saw, I think, a year or so ago. I don't know if you remember one of the central bankers from the Netherlands said that gold is the ultimate asset that is safe when everything goes wrong. So I think that's what the rest of the world is realizing, except ourselves in the West in general, that yeah, the dollar is not fit for purpose, and that's why it's going to keep driving gold demand. So those are two of the things the theory is that when you see higher prices like we've been seeing since COVID in 2020, mainly because of all the money printing and the fact that this money printing went this time not to the bond market. Well, it went partly to the bond market, but it also went straight into people's pockets, and people at the same time didn't have to work. Was they stayed at home. But historically, they come in waves. You have the first wave, second, and third. And I've just looked historically as well. It looks like in the 30s, even though we're told it was the Great Depression, we had deflation. Even then, we had inflationary waves. And if you read Benjamin Roth's Great Depression Diaries, which is a really good book, they were concerned about inflation in the 30s. So it's like nature. If you th throw a pebble on a lake, it makes waves, and it's more than one. And I think it's the same thing with money and currency and credit. And I think the fact that gold is broken out, well, it broke out really in February this year through that 2100, and it's kept going. Gold is usually like a forecaster of things. It feels it before everyone or the markets do. So I think that's what it's pointing to.
Based on fundamentals, Mario Innecco warns that a major deflationary collapse, similar to the 1930s, could lead to widespread bankruptcies among governments and banks. In such a scenario, he stresses the importance of holding tangible assets in preparation for what he describes as the biggest everything bubble in history. Gold prices surged in March when banking stress emerged in the wake of aggressive rate hikes by the U.S. Federal Reserve. Regarding banking sector vulnerabilities, Mario highlights a bail-in at Lindsay National Bank and warns rising interest rates are devaluing bonds and loans. He urges attention to FDIC reports, which show signs worse than 2008. According to an FDIC press release, the bank's failure stemmed from alleged fraud, and the Deposit Insurance Fund may have to cover about $43 million. About $7.1 million of the bank's deposits exceeded FDIC insurance limits. Furthermore, Mario points to historical examples, such as gold mining stocks like Homestake Mining surging during the Great Depression, and the resilience of gold as a store of value even during severe financial crises. Let's get back to the interview.
If you do have a major deflationary collapse or bust like we had in the 1930s, what we're going to see is bankruptcies everywhere. Not just, I think governments will go bankrupt, corporations, individuals, local governments, banks will go bankrupt. So, and if you hold cash in these banks or brokers or institutions, you're going to lose everything. So physical gold outside the system is going to go unobtainium. So that's how where I differ with him. I agree there could be a bust and a collapse, but you don't want to give up real money just when that's happening. You're going to be wiped out. That's the way I see it. And yes, the price on COMEX or paper gold might go down to 1,500, and when the Dow is down to 5,000, even that though is good. But what I think is the counterparty risk that's gonna destroy people's finances completely, and that's what happened in the 30s. And if you had gold in the 30s, you'd be laughing. And even during the 30s, home stake mining, I'm sure you know about this, went up like 500%. And the more things got worse, the more people wanted gold. And actually, the gold price was trading in Europe even after FDR banned gold ownership. The dollar started going down versus gold even before the revaluation in 1934 because people wanted gold. I read as well in Benjamin Roth's diary that in Australia there was a gold boom because people couldn't get cash from the bank because all the banks were failing. So I don't agree with that. I think it's a big mistake, and he might be right in the short term. Maybe when everything starts collapsing, gold will correct a bit, but it's the biggest risk, I think, is getting rid of something that has no counterparty risk, and you don't want to have counterparty risk in the biggest deflationary bust ever, because I agree with him that this is the biggest everything bubble ever. I've heard about the Lindsay National Bank in Oklahoma. And I spoke to Andy Schectman from Miles Franklin the other day, and he said they did a bail-in there, and no one's talking about it, and probably because it was such a small bank. The biggest thing to watch again, and it goes back to what I said in the beginning, watch the bond market because most banks hold bonds, yeah, as an asset. So if you go in there to your bank and put $1,000 in the bank, they'll take that and buy treasuries or commercial real estate with it. And if interest rates are going up, the value of all those loans are going to go down because it means instead of lending at 7%, let's say if yields continue to go higher, they're only lending at 4 or even 2 or 3. So yeah, it's really important to keep an eye on those FDIC quarterly reports, and I'm sure you've seen that chart. It looks horrible, even compared to '08. So yeah, that's another problem. The banks, I don't think they're out of the woods, and I think the BTFP, which is the program the Fed rolled out last March 2023 to kind of stop the bleeding after SVB collapse. That's almost back to zero, and they're not going to start it again. So yeah, it's the banks are yeah, they're I don't think anywhere near as healthy as maybe we'd be told by like Jay Powell, for example. And I think Warren Buffett knows this because he's been unloading a lot of Bank of America shares.
The U.S. banking crisis is a byproduct of risks accumulated over the past several years from extremely easy monetary policy. As we look ahead to 2025, certain gold assets stand out as potentially promising opportunities, while others carry risks that may outweigh their potential rewards. What steps are you taking to safeguard your investments in today's uncertain economy? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.